Morning, everyone. My name is Shalini Shanmugam, and I'll be talking on the topic called capital structure. So, I'll be talking on the meaning of capital structure, components, as well as the determinants of capital structure. So, I would like to start with the meaning of capital structure. Capital structure means arrangement of business funds or arrangement of different components of business funds, that is shareholders funds or borrowed funds in a particular proportion. So this is the meaning of capital structure. Now moving on to the determinants of capital structure, the first one is risk is one of the most important factor that influences the capital structure of a firm. So in a firm there are two types of risk. One is the financial risk and the business risk. Business risk is nothing but variability of earnings before interest and tax. So business risk is further classified into internal risk and external risk. Internal risk is nothing but it is improper product mix, non-availability of raw material, then absence of strategic management. So these are the examples of internal risk. External risk is nothing but certain conditions that is beyond the control of business is called as external risk. That is example business cycle. So this is one of the factor that influences the capital structure of a firm. The next one is requirement of investors. Requirement of investors is also another important factor, which means investors should be given importance, and investors requirements have to be fulfilled. There are two types of investors basically. That is the that is the there are two types of investors basically. One is the institutional investors, and the other one is the private investors. So usually these investors come into picture during the time of debt financing, and investors are also further classified into cautious investors, cautious investors, less cautious investors, and bold investors. So this is all about the requirement of investors. So in simple terms, investors requirements have to be taken into consideration while selecting the capital structure of a firm. So the next one is flotation cost is the next factor that influences the capital structure of a firm. So talking about the flotation cost, if say for example a company wants to raise funds in present times or in future, usually there's a cost that is involved at the time of raising of funds, which is called as the flotation cost. So flotation cost of debt is always cheaper as compared to flotation cost of equity shares, and that is why most of the companies and most of the firms, they tend to use more of debt and less of ordinary equity shares. So flotation cost is not a very important factor that influences the capital structure of a firm, but it still has an impact only on those firms which is very very small and they have just started their journey. So usually big firms do not get affected much by flotation cost. So the next determinant is the next one is capital market conditioning. We all know that capital market conditioning is basically something that is not stable, that is not constant. It keeps changing every time. It is just dynamic because capital market, say for example, the present market condition, if the market is facing depression, it is obvious and it is 100% guaranteed that in future the market would definitely be facing a boom. So since we know these such information, it is always advisable for certain business which is facing a pessimistic business condition not to issue any of the equity shares, because when investors come forward to invest in such equity shares, they tend to invest money without knowing whether the business is facing a good condition or a pessimistic condition, and finally when they do not get return on whatever amount that is being invested by them, this creates a grudge on the company as well as a bad reputation of the company. So in order to avoid it's always advisable for pessimistic business condition companies not to put forth any of their equity shares during those such times. And most of the conditions, if you see, usually investors are sensitive because they feel whatever money is being invested or whatever dollar or penny that is being invested by them in any of these shares have to be valued, and they should get a good return for each of the money that is being invested by them in any of the shares, as well as they also looking for good safety of the shares that is being held by them. So this is all about capital market conditioning. The next one is nature of business and size of business. Talking about nature of business and size of business is another important factor that also influences the capital structure of a firm, because when you talk about nature of business, there are two types of concerns that you should mainly think of. That is the public utility concern, and the other one is the manufacturing concern. If you look in public utility concern and manufacturing concerns, usually their capital structure is completely different from one another. They are just not the same. In public utility concern, most of the times if you see, they tend to use more of debt, because they have a consistent and a continuous earnings and income that they receive every time. So though they borrow more of debt, it's just not going to be a problem for them in order to repay back whatever debt that is being borrowed. Whereas in a manufacturing concern, they don't borrow any amount of debt, is because they do not get a consistent and a continuous income, or say regularity in their income is not possible. So that is the main reason as to why nature of a firm has to be taken into consideration when selecting the capital structure of a firm. Then moving on to size of a firm. So size of a firm is nothing but talking about a big firm and a small firm. If you see, even today in India, small firms are find it very difficult, and they struggle a lot to raise long-term funds, or say long-term loans. This is mainly because of several factors that has to be taken into consideration. The first one can be, they find the capital structure is always inflexible for small companies, and they find lots of hidden terms and conditions which they are not able to battle up, and they also face a high rate of return. So these such condition makes the management of a company not to work smoothly in future. And if a small company is required to raise long term funds, they have to completely depend upon their own capital as well as their retained earnings in order to raise such funds. So this is a condition of a small firm. This is a condition of a small size business. Whereas talking about a large size business, if you see, usually large size business, they can raise funds through different means. It is not going to be a problem for them to raise funds, because they can issue shares, such as equity shares, or say preference shares or debentures to the public, and easily they can raise funds. Whereas in small companies, that is not possible. And most of the time, if you see, the capital structure of a large size company is said to be flexible enough. So nature of firm and size of a company has to be taken into consideration effectively when you plan for a capital structure. So the next point is, so legal consideration is the next point. So legal consideration or legal requirement is another important factor that also influences the capital structure of a firm, because when in a company, if you see, usually there are many capital structure that is available, just not one. So when that is being assessed and evaluated on regular basis, it is the role and it is the responsibility of the financial manager to make sure that all the legal requirements as well as regulatory framework is being satisfied by the company. For example, if any redemption has to be bought in the debentures for about say 18 months, usually several requirements have to be fulfilled by the companies. The first requirement is they have to make sure that the credit rating is according to the SEBI guidelines, and then approval is supposed to be received from the SEBI in order to raise funds from the market within that is present within. So after this there are several procedures that is supposed to be followed. But if loans are borrowed from financial institution, not much requirements have to be fulfilled. So when choosing or selecting a capital structure of a firm, the financial manager has to make sure that all the above stated legal requirements or say regulatory framework is being satisfied by the company. So the next determinant is Growth and stability of sales is the next point. So talking about growth and stability of sale, this has a major impact on the capital structure of a company, because if you see, every company is expected to do extremely well in their performance in the past. Extremely well in performance simply means they should make sure that the sales that takes place should be stable, just not stable, but also there should be a growth in the sales that takes place, because when there is good growth and stability in sales that takes place from the past performance, we easily get to know, and it becomes obvious that the company is earning good profit, as well as regular income, as well as regular regular income, regular profits, and this helps the company to achieve their profits easily, and this helps the company also to fulfill their objectives also. So this not only enhances, so such condition not only enhances the current situation of the company, but also helps the company in future terms and conditions. Say for example, if a company is facing any financial crisis, they can easily overcome those crises without much difficulties. So I would also like to quote an example for this. For example, there is a company called X, and they have been doing really well in the past with good sales, good profit, and but presently they have thought of raising funds, which is unable for them to do. So the head of the organization has decided to borrow loans, or borrow debt from the debt lenders. But most of the time, if you see, neither the debt lenders nor the financial institution will not grant loans to the companies or satisfy their requirements as and when they want. Instead, they'll make sure that whether all the factors is being satisfied, all the legal requirements is being met by the company, only then loans will be provided to the company, no matter how well how no matter what condition the company is presently facing. So when funds are being provided to the company, usually the financial institution or the debt lender usually should feel satisfied and should feel confident that the loan that is being provided to the company will be repaid back in future without any form of difficulties or without any form of delays. So such confidence help the companies to gain loan. So such confidence can be assured by the company to the loan providers only on the basis of their past performances. So when there is good performances with good sales profits in the past, this gives a boost to both the loan providers to grant them with loans, and this also gives them a fixed committed feeling that the debt amount will be repaid back along with the interest rate without any form of delays. So now moving on to the components of capital structure. The first component is equity shareholders and not equity shareholders, shareholders funds, and that is further classified into three categories. And then you have borrowed funds, that is further classified into three categories. So the first one is shareholders funds. Usually in a company, if they want to raise funds, they tend to usually raise funds by issuing new shares, or they or utilizing retained earnings in order to meet up with the financial requirements of the company. So this is all about the shareholders funds, and this method is also an expensive method. So moving on to classification below the shareholders funds, the first one is equity shareholders. I'm sorry, it is not equity shareholders, it is equity capital. So new shares are usually given to the equity shareholders in the firm. So equity shareholders are none other than the owners of the company. They act as representative owners of the company. They have complete control over the company. They have all form of voting rights over the company. So they are also exposed to any form of losses associated with the company. And further, they are also liable to get dividends with respect to profits that is earned by the company. Now moving on to retained earnings. The next one is retained earnings. Retained earnings is nothing but if there is any funds that is left over in the company, that is usually taken into consideration as retained earnings after leaving some amount for growth and expansion of the company in future. The next one is preference share capital. So preference capital. So preference capital is when the preference shareholders are given preference when the preference rights, and they are also given a fixed rate of dividend, and preference shareholders usually they do not have complete control over the company, they don't have complete control over their voting rights as such. So this is all about preference shareholders as well as preferred capital. So moving on to borrowed capital. So moving on to borrowed funds, under this is the next classification. So under borrowed funds we have two categories. One is the debentures and the term loans. So term loans are nothing but loans that is being borrowed from the financial institutions such as banks, and usually the rate of interest on these term loans is either fixed or it is floating, and every company feels that borrowing loans from financial bank, it is a very essential source of income, and it also strengthens the financial position of the company. So now moving on to debentures. Debentures are it is nothing but it is an debt instrument that is issued by companies or companies or government to the public. Though the rate of interest of such debentures are very high, still public can purchase it without any collateral security. So it is affordable by not only very rich people, but even middle class individual can also afford it. So this is all about your components of a capital structure and determinants of a capital structure. So hereby I would conclude my topic on the meaning of capital structure, determinants of capital structure, and components of capital structure. And I would thank you for watching my video. Thank you.